and financial statements in the organization. And the operational decisions in the firm are examined through the analysis of financial performance and its financial position. And at the end of this webinar, you'll be able to describe the content of the 4 basic financial statements, discuss the importance of financial statement analysis to the financial manager, and evaluate firm profitability using the income statement, define the main concepts of accounting basics and the use of balance sheet to describe firm's investments in assets and the way it has financed them. And before anything else, I'd like to introduce to you our keynote speaker. Our keynote speaker has master's degree in finance and also doctorate degree in finance. And he has taught in some universities and colleges here in UAE. His recent employment was with European International College, and he was the academic director of EIC. And now he's the head of St. Mary's College in terms of the research. And he has written 14 articles, and 4 of which were indexed by ABDC. Let me first introduce to you one of the finest professors that I've known, Dr. Ravi Tati.
Thank you, Professor. May I start?
Go on, sir.
Okay, thank you all. Thank you for joining me. Today, we will be talking about financial statements, and many of you have opted for accounting as your program. Some of you have joined in BCom programs, and some of you might have joined in BBA program, and you have chosen accounting as your career. So now, when you look at accounting, I would like to share how a transaction passes through various steps and finally appear in the balance sheet. And I see some students with whom I had the interaction with regard to the financial statements. 2 basic financial statements I would like to share now. I'll discuss upon those things. Then I will add 2 more financial statements at the end of preparation of the balance sheet. Now, will you please allow me to share an Excel sheet? Yeah. So this is, if you take this as a case, now I'm presenting before you how a transaction passes through various steps and finally appears in balance sheet. This is what we are talking. Okay. Now, transaction 1, Shruti commenced business with a capital of 20,000 on the first day. And second transaction, she purchased machine for 20,000. 200,000 is what she has invested, out of which 20,000 she spent for purchasing the machine from a company. And she also bought some furniture for 5,000. And she bought some goods from Srinidhi for 30,000. She bought some goods for 20,000. And she bought goods, sold goods to Ankit for 60,000. And she sold goods for 50,000. We don't know to whom she sold. Salary she paid 5,000, and rent she paid 4,000. Commission she received 10,000. Wages 3,000. Now this is the data given to us, and this data pertains to Shruti, Miss Shruti. Now Shruti started business. Now in accounting, we have to understand the person who is starting the business is totally separate from his business or her business. And this in accountancy called separate entity concept. This is explained by a concept known as separate entity concept or business entity concept. So on this premise, all these transactions that Shruti carried on are on behalf of the company. Now, we should understand that Shruti is separate from her business, and she has carried on all these transactions on behalf of the company. So whatever she is lending, she is putting as 200,000 into the business. Uh, it is as if she is lending to the business. It is a lending. It is a kind of lending. So therefore, you will always see capital being on the liability side of any company's balance sheet. Fine. So let us look into, okay, I missed wages. Wages is one of the expenses. Let us look into. Now there are three concepts. Yeah, there are three concepts, accounting rules. Just give me a couple of seconds. Right. So there are three accounting rules. One is personal rule related to personal accounts, rule related to real accounts, and rule related to nominal account. Nominal account. So personal account, these persons can be artificial persons, statutory persons, or persons created by the law of the land. And let us come to the real account. Real account is account related to the assets of the company. And next is nominal account. Nominal account. This is an account related to expenses and incomes. Okay, so this is for the persons. It may be individuals created by the creator, God, or it can be created by the law of the land. Real accounts related to the assets. Nominal account related to the expenses and losses, incomes and gains. Okay, now personal account, if you look at the rule for personal account, is every time a person is receiving benefit, his account is debited, and every time if he is giving benefit, his account is credited, if it is personal account. If it is personal account. Okay, now is any one of you calling me? Would you please allow me? Maybe any of the participants, one of the participants may be calling. Would you please permit me to receive this call? Excuse me. Yes. Right. I'm sorry for it. I thought some of you are calling me if you are not able to see the screen. Okay. So, yes. The rule for personal account is debit whenever the account is receiving benefit. Rule for the personal account, whenever it is receiving, whenever it is giving benefit, it is credited. For example, look at this. I'm a person created by God naturally. I'm an individual, right? I borrow money from bank, ADCB, Abu Dhabi Commercial Bank, right? Abu Dhabi Commercial Bank is giving me. I'm taking the benefit. So therefore, Ravi's account debit, Ravi's account debit to Ravi's account debit to ADCB. ADCB is the giver of the benefit. Ravi is the receiver of the benefit. So debit the receiver, credit the giver. This is the rule. Okay. Now the rule for, the rule for real account is whenever you're purchasing an asset, debit that particular asset. Whenever you're selling the asset, credit that particular asset. So debit whenever the asset is coming in, credit whenever the asset is going out. Nominal account, debit all expenses and losses, credit all incomes and gains. For example, whenever there is an asset coming in, you bought a machine, so machine account debit, machine account debit to machine account debit to what's going out. When you buy the machine, cash goes out. So to cash account, to cash account, cash account. So cash is going out, one asset is going out, another asset is coming in. Machine is coming in, cash is going out. So debit what comes in, machine is coming in. Credit what goes out, cash is going out. So this is the rule for real account. Now let's come to the nominal account. Whenever you're making some payments, whenever you're making, you pay salary. Salary is an expense. And when you pay salary, what happens? Cash goes out. Look at this. Salary account debit, salary account debit, debit, DR I'm writing, which is the short form of the debit. Debit to cash account, cash account. Okay, cash account. Cash account. What is this? Cash is going out. Credit what goes out. Salary is an expense and salary is debited. So on these three rules, we will be journalizing the transactions. Now look at this. Plant is purchased. Before that, A. Shruti commenced business with a capital of 200,000 on the first day. Shruti brought in money in the form of capital. Okay. Actually, it is Shruti's capital account. Shruti is a person. It's a personal account. So therefore, Shruti is giving credit the giver. Okay. When I'm writing to means it is crediting the giver. Then what is coming in when she's pumping in money? Cash comes in. Cash account is receiver of the benefit. Cash account debit to capital account. 200,000, 200,000. So whatever she has given is whatever is received by the company. Shruti gave 200,000, the company received 200,000. Look at this. Cash received is 200,000 and that is given by Shruti. So debited the cash account, credited the capital account, right? You give a description that's called narration in the accounting. We'll learn that in the due course. Next, plant and machinery account. Plant and machinery account. Look at this. With the money that she has pumped in, 20,000 she spent for buying the plant and machinery. Plant and machinery account 20,000. Plant is coming in when she bought it for the company. Okay, when the company bought. Now let's set aside Shruti. When the company purchased asset is coming in and what goes out is 20,000 rupees going out. So debit what comes in. Plant and machinery account 20,000 debit to 20,000. So the second line is credit. The first line is debit. Right? And again, you are giving the description of every transaction. Okay, with a prefix being plant and machinery purchase for cash. And you go on giving the description for every transaction. That is the explanation for the transaction you're recording. Okay, next is C, purchased furniture for 5,000. Now, purchased furniture. Furniture comes in. Purchased furniture comes in. Debit what comes in. But what goes out? Cash goes out. Credit what goes out. The second line is for credit. First line is for debit. Furniture account debit to cash account 5,000 and 5,000. And let's come to the next one. D. Bought goods from Srinidhi. Srinidhi is a person. Srinidhi is a person. Okay. And what's coming in? Goods are coming in. Or purchases account. Purchases account debit to Srinidhi. Srinidhi is a giver, his account is credited. Purchase account, actually it is purchase of goods account. Goods are coming in and purchase also can be treated as expenses. Debit the expenses, credit the giver. 30,000, 30,000. Right? Next is, goods purchase, 20,000. Goods purchase, simply goods purchase. There's no name. Goods purchase, purchases account debit to cash account 20,000 and 20,000. What is this? There's no name given. When there's no name mentioned, it is implied that it is for cash. When cash is going out, cash is credited. When you're buying the goods, which is an expense or spending, that is debited. 20,000 debit, 20,000 credit. Next. Shruti sold goods to Ankit. Ankit bought goods worth 60,000. Debit the benefit receiver. Ankit account debit Where is that? Ankit account debit to sales account. So 60,000, 60,000, right? Next is, yeah, cash sales 50,000. There's no person's name, right? Cash comes in when you sell goods. Cash comes in, right? So cash account debit 50,000 to sales 50,000. So cash comes in when you sell goods. Debit what comes in, and how it is coming. It is in the form of sales. Sales is an income. Credit all incomes, right? Credited. Next, salary is an expense. Debit all expenses. Rent, debit all expenses. Commission received, income. Okay? Commission received is income. Salary and rent, we will debit. Look at this. Salary account debit to cash account. Rent account debit to cash account. These are expenses. When you're spending for a particular expense, that particular expense is debited, and cash is credited because cash goes out. Next one is commission received. Commission received is 10,000. That's an income or gain, right? So cash comes in 10,000 when you receive commission. It came in the form of commission, which is an income that is credited, right? And last of all, wages paid 3,000, right? Wages paid 3,000. Wages expense, debit all expenses to cash. Cash goes out, okay, 3,000. Now, when you observe this journal entry, which is the book of original entry in accounting, this is called journal. A journal has three important columns. Okay, there's a particulars column, there's a debit column, there's a credit column. For every transaction, when you looked at, it has two effects. That is why the accounts are recorded on a system called double entry system. This is introduced by Luca Pacioli. This is, for the first time, he coined this sentence, okay, double entry system. And he started recording his transactions in the same system. That has become order now. Every transaction, if there is a giver, there is a receiver. If there is a receiver, there's a giver. That is the premise under double entry system. Look at this. When cash comes in, that is debited, who is giving? Shruti is giving. Shruti is giving that cash. When plant is purchased, plant account is taking benefit. And how is this plant is purchased? By paying cash. Cash account is giving benefit. Benefit giver is credited always in accounting. Benefit receiver is debited always in the accounting. Fine. Now, I didn't tell you the definition of accounting. I just started straight away with the case. This is a small case which I'm taking to make you understand what a financial statement like balance sheet is, what a financial statement like income statement is. To make you understand, I've taken this case. Fine. Now, accounting is the process of recording. Now, we have recorded. Yeah, this is how we recorded. Now, after that, it is not only process of recording, it is also process of classifying, process of recording and classifying. Look at this. What we do is, wherever you find cash in this, what you have recorded, look at this. There's cashier, there's cashier, there's cashier, there is cashier, there is cashier, there's cashier and cashier and cashier and cashier. These many cash is witnessed in all these transactions or entries. So all these things you will take into another book called ledger. This is called journal. Whenever a transaction takes place, for the first time you record in this book called journal. And you don't segregate it. Account wise, you don't segregate it. As it happens, so you are recording. It's journal, book of original entry, primary book. It's a book of primary entry. Fine. What you've recorded just like that, you will classify. That's called posting them into ledger. This is a classification. Now, what you do is, you will pick up one account and search for how many times that account has been repeated. Let's say, for example, cash account we are preparing. How many times the cash is repeated, right? When, yeah, look at this. First time, cash account debit to capital, right? Cash account debit to capital. First time it is, look at this, cash account debit to capital account, 200,000. Again, you can see, yeah, again you can see plant and machinery account debit to cash account. Look at this. Plant and machinery is purchased with 20,000, right? In this transaction, cash is debited. The second transaction, cash is credited. So look at this. Cash is credited with plant and machinery with 20,000. And let's go ahead. The third transaction, cash is again credited with the furniture. Cash is again credited with furniture of 5,000. And again, let's go to the next one. Wherever you find cash, yeah, cash is again credited in purchases. Look at this. Purchases is what? Return and purchase of material for 20,000. Next, yeah, cash is 50,000 debited, right? Cash is 50,000 debited. What is that? Sales. And similarly, cash is, yeah, credited with salary. Cash is credited with the salary, 5,000. Cash is, yeah, credited with the rent, okay, in the ledger. Cash is credited with rent in the ledger account. Next, you will go on. Commission received. Cash account debit to commission account. It's debited. Cash is debited, okay, with commission, 10,000 rupees. Next, cash is credited with wages. Cash is credited with wages with 3,000 rupees. Look at this. There are some debit items. There are some credit items. Okay, credit items. The total of credit is 2,60,000, whereas the total of debits is, I'm sorry, where the total of debit is 2,60,000, whereas the total of credit is less than that. Look at this. Yeah, 2,50,000, 2,50,000 plus 10,000, 2,60,000 is the total. And when you look at the credit side, 20 plus 5, 25 plus 20, 45 plus 5, 50, 50 plus 4, 54, 54 plus 3, 57. 57,000 is the total on the credit side. There is a gap. That gap is a balancing figure. That is the gap which is used. Yeah, in that gap, what's that gap? 2,03,000 is the gap between the debit side and the credit side. The total of debit side is 260,000, whereas the total of credit side is 57,000. This total is 57,000. 57,000. There's a gap of 2,03,000. What is this 2,03,000? This is balancing figure. Why do we call it balancing figure? Because this amount, if you put here, this will make the total of both the sides equal and it balances. That's why it's called balancing figure. And we write in accounting by balance carried down, which means the debit side is in excess of 203,000 over the credit side. So the account shows a debit balance of 203,000. That means you have a cash balance of 203,000. And you go on doing the accounts like this. When you come to capital account, look at this. What is that? There's only one item in the capital account. Cash account debit to capital account, right? Yeah. Capital account debit to, I'm sorry, cash account debit to capital account. Cash account, okay, debit to capital account. Cash account debit to capital account. That means capital account is credited with cash account for 200,000. There's nothing on the credit debit side. So therefore, total of the credit side is 200,000, whereas total of debit is 0. So therefore, you're putting this amount on the debit side so that the total of both the sides is equal. Look at this. Here it is 0, nothing is there. Here it is 200,000. There's 0 here, there is 200,000. To make both the totals equal, you drop that amount, whichever side it is falling short, and that you call it balancing figure because it balances both the sides, and you're writing to balance carried down. If it is debit side, we are using a prefix called to. If it is credit side, we are using a prefix called by. And you go on like this. Plant and machinery. You bought plant or machinery, right? When you bought it, plant and machinery account debit to cash account, and you spent 20,000. Nothing on the credit side. Okay, the total of debit is 20,000. The total of credit is 0. Nothing is there, right? And you have put that amount to equate both the totals by balance carried down 20,000. Okay, right? And what does it mean? The excess of debit over the credit is 20,000. And you go on preparing the statement, segregating the accounts like this. And finally, you will take the summary of all the accounts, That's called trial balance. Look at this. The summary of the account cash is 203,000 debit balance. The summary of capital account is 200,000 of credit balance. The summary of plant and machinery account is 20,000 of debit balance. And the summary of furniture account is 5,000 debit balance. And purchase account, 50,000 debit balance. And sales account, 1,10,000 credit balance. Srinidhi account, 30,000 credit balance. And Ankit account, 60,000 debit balance. Salary account, debit of 5,000. Rent account, debit of 4,000. Commission account, credit of 10,000. Wages account, debit of 3,000. Look at this. When you are taking the summaries, now where did I take from? In order to reduce the time, I'm not discussing all the accounts in the ledger posting, but simply I have taken the amounts. Look at this. From the cash account, I've taken the balancing figure and dropped in the trial balance. This is the trial balance. Then I did the same thing with capital. If it is debit balance, I'm writing on the debit column. If it is credit column, I'm writing on the credit column, right? And at the end, you must understand that the debit side total should be equal with the credit side total. Okay. And what is this? Again, let me come back to the process of accounting or definition of accounting. The accounting can be defined like this. Accounting is a process of recording. Okay, this is what you have done in recording. And it is a process of classifying. This is what you have done to classify. That's posting them into ledger accounts. And it is summarizing. Summarizing started with trial balance. What is this? It is summary of cash account. This is summary of capital account. This is summary of plant account. This is summary of furniture account. This is summary of purchases account. This is summary of sales account, and goes on. All the summary, the whole summary of all the accounts are taken here. That's why it is a process of recording, classifying, and now we are summarizing. Summarizing is not complete here. What we do is these transactions we will classify into 4. Look at this. We will classify into 4. What is that? Expenses, okay, losses, okay, and I'll take here expenses, right, and losses, okay, then incomes, right, and gains, right. Next, liabilities and assets. Look at this one. I have to segregate these from these. I had to segregate what is an expense, what is an income, what is a loss, what is a gain. For example, can you please go on telling me, if you can, cash, is it an asset or liability or expense or income or loss? Let's say yeah, let's say if expense is denoted with E and yeah, losses, yeah, losses with L, yeah, gains with G, and incomes with, yeah, incomes with I, right? Liabilities with L, okay, LI, and assets with A, right? Okay, liabilities LI. Now cash, what is this? It is an
Asset.
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 Yeah, an asset. So we will make 6 colors. We will give 6 colors. Let's say I'll write red for asset. Okay, all assets are in red. Now capital,
Liability.
Liability.
all liabilities in blue. Okay, then plant, again
Asset.
red.
Asset.
Okay, which is an asset. Furniture, what is
Asset.
it?
Asset.
Asset. And purchases, let's say
Expense.
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 Expense I will green, I will give. Okay, then goods sold, income. Income I will give yellow color. Okay, Srinidhi, Srinidhi is a creditor. Srinidhi is a creditor, the one who supplied goods to us. He is the one to whom we have to pay. We are obligated to him. He is a liability, right? He is a liability. So what's the color for liability? Liability color
Blue.
blue. Okay. I'm sorry, Srinidhi. Yeah. Ankit is the one from whom we have to collect the money, and it is an asset. Asset is in red. Salary is an expense,
Expense.
right? And expense is given in yeah, green. Then rent, expense, green. Commission received, income.
Income.
What's the color of income? What's the color of income? Yellow.
Yellow. Yellow.
And wages, expense.
Expense.
Yeah, wages, expense. What's the color for expense?
Green.
Green. Right. So done. Your work is done. You can prepare balance sheet. Look at this. All reds you take it in the debit side of the profit and loss account. Look at this. Purchase in red. Yeah. Purchase in red. I'm sorry. Purchase is green, right? All green are expenses. Look at this. 1 expense, 2 expense, 3 expense, 4 expense. So purchases, salary, rent, wage. Okay. Now look at this. Purchases, salary, rent, wage. 5543. The total is 50 plus 50, 55, 59.
62.
62 is the total. 62 is the total. Okay. And let's come back. Incomes. How did we denote the income color with?
Yellow, sir.
Yellow. Yellow. Goods sold. Goods sold 110. Right. Commission received 10. Right. So goods sold, which is sales, 110. Commission received 10. The total is 1,20,000. 1,20,000 on both the sides. And the total, look at this, the total on the credit is 62, whereas the total on the debit, I'm sorry, the total on the credit is 120, total on the debit is 62, difference is 58,000. And we fill the gap again. You know, this is the convention in accounting, that we fill the gap, and that gap amount, we call it balancing figure. Look at this. Since we are preparing profit and loss account, profit and loss account is the nominal account. The rule for nominal account is debit all expenses and losses and credit all incomes and gains. And what we do is we are debiting all expenses, which is 62,000. We are crediting all incomes, which is 120. 120 minus 62, gives you 58,000, which is excess of credit over debit, or in layman's language, excess of income over the expenses, which is 58,000. What is that? Net profit. If the expenses are in excess of income, what is that? That's a net loss. Fine, you did well. You have marked the incomes and expenses, and you got the net profit. Now what's left over is assets, okay, and liabilities. All red are assets, right? Cash is an asset, plant is an asset, furniture is an asset, Ankit asset. There are 4 items of assets. Look at this, 4 items of assets. Plant and machinery 20,000, furniture 5,000, Ankit 60,000, cash 2,03,000. Okay, 2,03,000. 4 items. And similarly, liabilities. How did we denote? All blue or liabilities? Capital 200,000, Srinidhi 30,000. Okay, right. 2 items. Capital 200,000, Srinidhi 30,000. Look at this. You started with the capital of 200,000, and you got a profit of, you made a profit of 58,000. How did you get this 58,000? This 58,000 is brought here and added to the capital. Your capital now became 2,58,000. You started with 200,000, now it became 258,000. Okay, and over and above that, you have 30,000 obligation which you have to meet, right? So all these are liabilities and all these are assets. If you look at the liabilities total is equal to the assets total, for the reason that balance sheet should tally. For the reason that you cannot spend, what you spend is this. What you spend is this. What is that? This is what you spend. What you spend is with what you have raised. This is what you have raised and this is what you have spent for. Is anyone waiting? Oh. Yeah, Mr. Ben, I'm so sorry to make you wait. I couldn't check you. Okay. Yeah. Right. So you have spent from what you have received. Okay. So balance sheet should tally. This is a rule. Balance sheet should tally. Why it should tally? Because you cannot spend more than what you have. What you have is this, and what you spent is this. Okay, what you spent is this, and this is the amount left over. This is the amount left over as cash balance in your hand. Fine. Now this is the profit and loss account and balance sheet. Now I would like to tell you the profit and loss account could give you the result of business operations. And what is the result? The profit. And sometimes it can be loss. The result can be profit or loss. It can be positive or it can be negative. And also it presents how the company is performing. Okay, how the company is performing. When you look at these figures, you know how you can control the expenses and how you can enhance the incomes, right? Now, when you look at the balance sheet, it tells you the position of liabilities and assets. What's the position of liabilities and assets? How much you're owing to the parties outside the business, and what's the worth of the assets you're possessing in your premises? What's the property that you're holding in the premises, and what's the money that you are obligated to pay to the outsiders? So this is called as position statement. There are 2 important statements in financial statements. There are 4 rather. Okay, 2 are very important. One is income statement, or called profit and loss account. The accountants call it profit and loss account. The managers call it income statement. Both are same. Look at this. If the same profit and loss account is prepared vertically, taking the incomes at the top and taking a total of all the incomes and taking the expenses at the bottom, taking the total of all those expenses, deduct the total of expenses from the incomes, and you get what is called as net profit or net loss. that's income statement. But if you prepare both on the debit side or two sides, horizontally, if you're preparing, you have a debit side and a credit side, and that's called account. Profit and loss account tells you or gives you or presents before you what's the performance of the company, how the company is performing, what's the profit made during the year or a given accounting period, and what is the profit made, what's the loss sustained. And also the balance sheet. What's a balance sheet? It's a position statement. What's that? Position of liabilities and assets. Now, in addition to these two, you have one statement called cash flow statement. In some countries, this cash flow statement is added, okay, as a mandatory statement, okay, under Companies Act 1956, which is being amended again and again, even under Companies Act 2013 of India. Cash flow statement preparation is must. Even in 2016 amendment, cash flow statement preparation is must. What is that cash flow statement? Now look at this. I may say this is the profit I made, but is that exactly the cash amount? No, not necessarily be. It not necessarily be the profit. It can be, fiduciary, right? So there's no liquid cash available. Profit made is so much, but there's no liquid cash available. So now the companies say, or Companies Act says, no, let there be another statement which exactly tells what's the amount of cash flows into the company and the amount of cash that is flowing out of the company, right? That's called cash flow statement. Now, cash flow statement preparation is under three heads. Cash flows through financing activities, cash flows from operating activities, cash flows from investing activities. Look at this. When it is financing activities, whenever you're raising money for the business for, expansion plans or existing, working capital needs, whenever you're raising money from the market, okay, cash comes in, right? And when you're paying, now look at this, you can even raise from the bank, financial institutions. When you're raising from financial institutions, cash comes in. What you have received, you have to pay. Once the contractual obligation date is expiring, maybe let's say you have taken it for 5 years, you're taking it for 10 years, right? After 10 years or 5 years, you have to repay it back. When you're repaying, cash goes out, okay? Now, first year you have raised 10 crores cash from bank loan. After 5 years, it will be repaid, okay? Or maybe let's say every year 1 crore is repaid, right? So cash flows in the first year is 5 crores. The next year, 1 crore cash outflow. Okay. So what's the net cash flow? Net cash flow. There are outflows through financing activities. There are inflows. What's the exact net of the cash flow? Okay. That is given by the cash flow statement. Cash flow statement has 3 important steps. One is through financing activities, investing activities. What's that? When you're investing in procurement of the assets, you pay money, right? And when you're selling those very assets, let's say I sold off one of my plants. I have plants in 4 places. One plant I'm selling it off out of 4. I'm retaining only 3 and 1 I'm selling it off for 20 crores. What's that? When I sell that plant, I get 20 crores. Cash comes in. When I have set up those plants, I spend 100 crores, right? One of those plants which I set up for 100 crores, I'm selling off. When I'm selling off, I get money. What's that? Cash inflow. There's a cash outflow when I'm, erecting the plant. There's a cash inflow when I'm selling it off to somebody, right? There's a cash flow through investing activities. And there's cash flow from operating activities. My core business is, let's say, to make automobile and selling it. That's my business. So through this, I make some money, either profit or loss. That's cash flow from operating activities. So cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. Okay, this is cash flow statement. Now there's one more statement which is not mandatory, but this is prepared by the managers for their convenience sake for making rational decisions. That's called funds flow statement. What is that? How the funds are moving Okay, from 1 year to another year. What's the amount of money that is being, look at this funds flow statement. Please remember, funds flow statement is different from cash flow statement. Cash flow statement deals only with, cash. But when it comes to funds flow statement, it tells you how the funds are moving from one accounting period to another accounting period. Okay, and look at this. The focus is given more on the working capital. And you know what is working capital? The gross investment or investment in the gross liquid assets. What are the liquid assets? It may be materials. Okay, it may be materials, it may be credit sales. So this, you need working capital. The amount invested in current assets, the assets which can be liquidated in a short period, are called as current assets. So the amount invested grossly in the current assets is gross working capital. There are liquid assets and there are current obligations also, right? When you say current assets which are liquidated in a short period, that is within 1 year or 12 months, there are also current obligations which you have to meet within a short period. What are they? They are called current liabilities. So if you deduct the current liabilities from the current assets, you get net working capital. Okay, and for this you prepare working capital statement in the preparation of funds flow statement. Okay, now working cap or schedule of working capital statement or schedule of working capital. You prepare schedule of working capital or statement of working capital. What's that? How the working capital is changing from year to year, right? What was the working capital requirement during the last year? What's the requirement of working capital this year? Okay, how the working capital has been changing, and in total how the fund is flowing into the company or out of the company from last accounting period to this accounting period. Okay, now let me say these two statements, cash flow and fund flow statements put together, are called as statements of changes in the financial position. Yeah, gentlemen, ladies and gentlemen, and when you look at the balance sheet, it is the position statement. It gives you the position of a given date. Let's look at this. Balance sheet of Shruti, let me write today's date, or yeah, balance sheet of Shruti as on 31st March 2016. I'm sorry, 2021. Look at this. On this date, this is the position of my company, my business. But how this position is changing from 2020 to 2021 because of the pandemic? Is your position, financial position, changed? Yes, it is changed. How much it is changed? How do you know? You will know from cash flow statement and funds flow statement. Now let me conclude. There are 4 important statements. One is profit and loss account or income statement, balance sheet, cash flow statement, and funds flow statement. Now, because of the very short time of 1 hour, I tried my best to fit all these 4 statements in just 1 hour span. But if given time, maybe 10 sessions, if we can have, we can exhaustively learn the entire preparation of profit and loss account. You can prepare your own cash flow statement. You can prepare your own funds flow statement. And in 3 sessions or 4 sessions, it's easy to prepare. And feel free to contact me or Professor Ernest for any of your learning needs. Thank you so much. And questions, please. I'll stop here and I would like to take questions from you.
Thank you so much, Dr. Ravi, for that very detailed explanation with regards to the accounting process and also the different financial statements. I still remember, when I was studying accounting, when my professor was doing the lecture with regards to accounting process, he was telling us, accounting process, you should memorize this acronym, RCSI. Okay, R was already explained by Dr. Ravi, That is what you call the recording. So if you do recording, you would be journalizing. You know, you put the debit and you put the credit. And R, then C, okay, that would be classifying. You need to classify which account, whether that's cash, whether that's purchase or commission. And the next one, you have summarizing, okay, as stated by Dr. Rabi, that would be part of the trial balance. But one more thing, there is what we call interpreting. And what is that interpreting? Interpreting the financial information. Okay, if you're going to look at the balance sheet, you could interpret the financial information on the balance sheet. You could get the liquidity, okay, the solvency of the company, and also for the profit and loss, you could see also the profitability. And if we're speaking also of the financial statement as stated by Dr. Rabi, he mentioned 4 financial statements. We have the profit and loss statement. If we're speaking of the profit and loss statement, it shows the result of the operation, whether the company is earning profit or not. And if we're speaking of the balance sheet, it shows the financial position of the company. Okay, why it's showing the financial position of the company? Basically, you will be able to see whether the company is liquid or not. Check the liability of the company, check the cash of the company. Are they capable of paying the liability? So you would see there the solvency of the company. That's why if we're speaking of the balance sheet, it shows the financial position of the company. And also Dr. Rabi made mention about another financial statement. We have the funds flow statement and also the cash flow statements. Thank you so much for that. Definitely, Dr. Rabi, we will be having more sessions with you. And as for the participants, if you would like to ask questions, you are welcome to ask questions. Okay, so I guess there are no more questions. Dr. Rabi, can you just open the Excel again and go back to the journalizing section?
Yes, please. Okay, can you see my screen?
Oh, not yet.
Not yet, okay. 1 second, Professor. Yeah, can you see?
Go to the journal. Okay, can you just go up?
Right.
Just go up on top. Top portion.
Top portion, okay.
Okay, can I read the transactions there?
I'm sorry.
Okay, like for example, there's one transaction there, like we have here. I remember, you know, when I was giving some transactions to my students, there's this one of my students who asked question. For example, let me just use this transaction here. Purchase furniture, okay, for 5,000, right? You have their purchase furniture for 5,000. So one of the students asked me, sir, how would we know, okay, how would we know if that furniture is cash or is account payable? It's not stated on the transaction. So what is the basic rule if it's not stated cash or it's not stated accounts payable?
Yeah. Here, furniture purchase for 5,000. If the name is given here, we can understand that it is for credit. You asked me whether it is for cash or credit?
Yes.
Okay. If there's a name given, then we understand it is for cash. If there's no cash mentioned. Let's say the rule is purchase of furniture for rupees 5,000. If, let's say, I'll write here, purchase of furniture from Edward for rupees 5,000. Here there's a name given, but there is no cash mentioned.
Right.
So you can understand this is for credit.
Okay, so that's clear.
But if there is no name given, simply it is given as this: purchase of furniture For, there's no from. Now, generally we remember, or the business has to remember, when it is a credit transaction, the business has to remember the name of the person with whom you had the credit transaction. So when the name is given without cash being mentioned, we understand that's a credit transaction. But
Okay.
if there's a name given, there's a cash given, that's a cash transaction. There's no name given, there's no cash given, that's a cash transaction.
Okay, that's clear enough. So as for the summary of that, if, for example, the cash is not stated, then it is assumed that it is cash. However, if there is a name given, okay, it is assumed that that is on credit.
Credit, yes.
Okay, thank you so much, Dr. Rabi, for that clarification. Any more questions from the participants? Okay, if there are no more questions from the participants, the Jaraso Education Institute would be issuing certificates to all the participants who attended this webinar. So if you are interested to get the certificates, kindly message the person who shared the link of this webinar, and we'll be sending to you the soft copy of the certificates from Jaraso Education Institute. And for our keynote speaker, I am hopeful, Dr. Rabi, that we could have more sessions with you. You could give more free webinars in behalf of Jaraso Education Institute.
Thank you, Professor Ernest. Thank you for the opportunity given me. Thank you all the participants for sparing time to spend time and learn some of the accounting concepts. Thank you very much. Take care.
Okay.
Thank you.
Thank you to all the participants, and thank you so much, Dr. Rabi.
Thank you, sir.
Thank you. Good day.